Hi, this is Sunny Kelsey here from Kelsey Wealth Management, and I'm here with the market update for the first quarter of 2024. So, if you take a look at the US market numbers, the market in US is up by 10.78% for the first 3 months. The Canadian market is also up by 6.2. The only thing in red is the bonds, and the reason being the bonds and interest rates have an inverse relationship. So when expectation of interest rates going low gets pushed back, our bonds don't do good in that environment. So last couple of quarters of 2023 have started to do well, as it was widely anticipated that interest rates will start to come down sometime in 2024. But with the recent data that came out, especially last few days, what we heard from the US market, the market is still running strong. Employment, especially in states, is high. So governments and both Feds and Bank of Canada have hinted that they might not be that aggressive in cutting rates. So this has led to a temporary setback in the bond return. So it really comes down to interest rate. So prime in Canada is 7.2%, and that has been since July of 2023. So we're almost kind of at the 1 year mark where interest rates have not gone up. And I think you would probably agree with that interest rates hikes are done. And most investors believe that we are not going to see any more hikes, especially where the economy is right now. And if anything, the next action, both from Feds and the Bank of Canada, is rate cuts. But that's $1 million question. First one, when it's going to happen, and secondly, how steep the rate cuts would be. And that's the part that's hard to predict. Maybe it happens this summer, maybe fall, or it might even get pushed to, say, 2025. So if you look at the inflation number from Feb of last year to this year, and this is the latest data we have, it went from 6% inflation to 3.2% in 2024. So it has definitely come down almost close to half. But interestingly, if you look at June last year to now, the interest rates have stabilized around 3.2% mark. And like the Feds call it, the inflation is sticky. And that's directly correlated with interest rates. The current prime is 7.2%. Last time the raise was 7.2 was in July of 2023. Inflation in July of last year was 3.2. Inflation in Feb of this year is exactly the same, 3.2%. So what we need to see is the inflation numbers to come down and for Feds and Bank of Canada to further cut rates. And that would be the next stimulant for the economy. But what's going to get them to do that? For that, the things need to slow down, layoff needs to happen, and that will cut down the spending. So the question comes, where do we see the opportunity? I firmly believe that the best way to get the most out of stock market is to stay invested for the long haul, and like any other asset, right? Whether it be real estate or any other investment that we might be invested in, oftentimes it's the time in the market, the timing of the market that gets you the greatest return. So if you look at the data of stock market in US for the last 100 years, it has returned 10% average annualized return. And this is higher than gold, higher than commodities, higher than real estate. Sometimes you do get pockets where some asset class will do better than others. And right now we're starting to see some attractive opportunities. Same thing that I've been saying for the last 6 months. Fixed income continue to look more and more attractive, especially if you think interest rates will start to come down in future. So fixed income is basically lending money to government or corporation in form of bonds, and two ways you make money on that. So one is interest income you collect, which is now the highest it has been in the last 2 years. So we're collecting 5 to 6% fixed rate of return, and there's also a possibility of capital gain. Because if interest rates were to come down and you lend money to the government for say 5 to 6% for 10 or next 20 years, your bond then also will have a capital gain attached to it. So that's the kind of double benefit of having some exposure to fixed income. The second opportunity we are seeing, same as last time, is dividend paying companies. So a lot of banks, utility companies, they have a negative correlation to interest rates. So when interest rates go higher, utility companies don't do that well, banks don't do as well, because there's a fear of recession. And also typically people who invest in dividend paying companies tend to be more conservative. But as soon as GIC rates start to slow down, the dividend paying companies will start to look attractive again. And once that money starts to flow through, you're going to have a good rate of return. But while we wait for that to happen, we're still collecting our 5 to 6% dividend rates. Big banks like TD or utility companies like TELUS, Rogers, they're giving great dividend numbers, and they're far better than what you will get in a savings account. And there's obviously a potential of capital gain. Now, to end things, I'd like to give an insight about investment psychology, because that's more important than actual investment. So I just talked about the investment market return above about 10% return or close to it in the last 100 years. But if you look at the average person, it's nowhere, their return is nowhere near that 10% mark. The reason being, we are humans and we're emotional beings. So when things go up, we get overly excited, we want to buy more of it. And when things go down, we get overly negative or pessimistic and sell. And often this is contrary to what you should be doing. So really, it's important to understand the price we need to pay when we're investing. So to give a parallel example, imagine or think about buying a car. And this we have done at least once or twice in a lifetime. So an easy example to follow. And let's say this car costs us $50,000 to purchase. So first option would be basically we go to a dealership and we pay the price. Either we pay cash or say get a loan. Second option is you don't want to pay $50,000. You don't want to spend that much, and you want to spend something less, say $25,000. So you will go for a different car. And third option, which is rather interesting, you will go choose to steal the car because you don't want to pay $50,000, but you want the same car. Hopefully, nobody in their rational mind will pick option 3. You might get away with it, but it's not worth the risk. So when it comes to investment, often we want to steal the investment return without paying the price. And what I mean by that is the price we need to pay to get the 10% average annualized return over 100 or 50 years. That is that you will go through periods of investing with a negative 20 or 30% returns. And what you do in those moments, those years, will determine whether you will be a successful investor or you will lock in your losses. So that's why it's important to have this discussion now. We are coming in from markets that have given us a double-digit return in last few quarters last year. And already with this year, we are up 6 to sometimes even 10% this year in the first 3 months. But sooner or later, we will see some pullback in the markets. That's normal. The market's being volatile. That's normal. And it's the price we need to pay for the admission to the market. If you feel you don't want to do that, you don't want to pay the price, I would suggest don't invest in market at all, or say settle for less. You can be in fixed income bonds or not having all your money in the market. You can have say 50 to 60% in market and rest in low risk assets. But the important thing is you know your risk tolerance. You need to know your risk tolerance. What you don't want to do is that your expectation is a 10% plus annualized return, but you don't want to see a negative statement. And unfortunately, that does not happen consistently in the real world. So there you have it. This is a market update for you. Hope you got some value out of it. Feel free to contact me if you have any questions. If you want to discuss your portfolio, do let me know. In the meantime,